Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Phil Mackintosh, Chief Economist at Nasdaq, Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Phil Blancato, he is the Chief Market Strategist at Osaic, and Chris Englebert, Founding Partner and CIO of Englebert Investment Advisors. And we're here to discuss why the U.S. economy looks a lot like the stock market. Chris, it's great to see you as always, and welcome back to Trade Talks. Phil, welcome to Trade Talks. It feels as if the market and the economy, they're acting the same because they're being interpreted in different ways, depending on what side.
Yeah, I mean, we've been a big proponent of small mid-cap stocks because they're cheap. They still stay cheap, but what's happening right now, and this may be a little controversial, but I really believe that the Magnificent Seven, we all know what those stocks are, have literally become the meme stocks of the summer. They just keep going up because they keep going up. And this is kind of reflective of the economy where, wealthy investors are still out there spending money, buying cars, boats, real estate, et cetera. But, individuals that are not making as much money are struggling because of inflation. And we all know how that's turning out.
Yeah, and Phil, it's almost like we're tired of talking about the Fed and what it's going to do with this interest rate cut. Should we get one or two this year? Is it really going to move the needle and make that much of an impact to people who are not perceiving the economy as great as it should be?
Yeah, and I guess I'm always on the other side of this. I feel like I'm the person who wants to take the story for the guy who didn't make a lot of money. I think we forget that the average raise over the last 5 years has been the greatest in the last 30 years. The average person who made 50 grand now makes 65, and yes, some of them are still living paycheck to paycheck. But the U.S. consumer is more wealthy today and stronger today than I'd argue it's ever been. And the reason why, because of this massive lift-off in wages, and yeah, we're dealing with a 40% hike in inflation, but you see some uptick in credit card debt. We're about the same default rate we were 2019. So I'd argue the reason why the market's grinding higher is not because they just go up, it's because these names are great names. They're defensive in nature because they make so much money. Their valuations are not inexpensive, but certainly not expensive. So you got this bellwether group of names that's doing really well. The other names, 50% of them aren't even above the 200-day moving average. So what does it mean? Easy. You made a bunch of money here. The U.S. economy's fine. Rotate some of that money to mid and small. I don't have a problem with that, especially large value. Fed cuts rates. What's going to do well? You lift off in those other sectors because the U.S. consumer is still strong. And I don't think the consumer breaks unless we stay too high for too long on interest rates to where it really becomes excessive. And we're not there yet. You look at the labor market. There's some cracks. There's definitely some things we could point to saying, okay, there's this minor deterioration, but in no way is the consumer fatigued, really out of money, or so stressed that they're not spending. Look at airlines, hotels, restaurants, and so on. It's still fine. It's Goldilocks right now.
Certainly in services, that's for sure.
It's certainly in services.
Right, but Phil, from your perspective, would you call this a rebalance in terms of unemployment? It doesn't sound, it's not really that bad to the other Phil's point.
Yeah, I think there are cracks, and I think the Fed's just started to talk about them, and I worry that we've been too high for too long already, because inflation, if you look at the PCE, is 2.6%. If their target's 2, and we've come from nearly 6, like we're getting pretty close to target, and we're still at peak rates. And if you look what that's doing to the housing market, like people can't afford to leave their old mortgages, and so there's no supply of housing. Like a lot of the distortions that are happening, the unrealized losses in a lot of the regional banks are because interest rates are so high, so the value of the debt securities has gone down. Just toning down the interest rates would probably reduce some of the risks of a policy error. And like you said, the consumer is still strong, but there's some cracks in the employment side. The unemployment rate now is over 4%, 4.1%. We haven't seen massive layoffs, but we've seen that starting to turn. The trend is definitely not favorable right now, so I would like to see the Fed cut a couple of times and get ahead of the curve rather than be behind it.
Do you think they'll do a couple of times in 2024?
The market doesn't think so.
Yeah.
So unfortunately, the only thing that's going to make that happen is some really bad data, and then you're starting to cut because of a recession risk,
right,
not because you're trying to get ahead of the consumer and have a soft landing.
Right.
I bet Canada spooked them a bit, though, just to tag on to that. They cut rates and they had a big nasty inflation print. Similar scenario in Europe. So they want to be sensitive to say they can't lose that credibility. So I don't know that they go soon. I agree with the other side of November at a minimum.
Yeah, and Max, you and I have spoken about this, and other strategists that we've had on the show, they're thinking November as well. It's a day after the election, so it removes that perception of it being a political move for the Fed as well.
Yeah, for sure. I mean, they have to worry about, like you're talking about, the credibility, how it's viewed. Is it a political move, or the kind of the why they're cutting? And that's kind of one of the discussions we've had on the desk is the why. Is it because inflation has reached their target, or is it because they're starting to get worried about what they're starting to see in the data? obviously unemployment's not too bad, ticked over 4%, but close with the SOM roll to triggering there. So again, are they going to be too late where the negative impacts are really going to start to weigh on markets versus trying to get ahead of it? Whereas we saw when inflation started to pick up, they were very slow to raise rates. When they're waiting, they were caught behind the 8 ball, and then all of a sudden it's this huge catch-up trade, and we had 50 bips, 75 bips hikes at a time. 25 at a time, trying to get ahead of it is, I think, where the market would like. I think now we do have 2 priced in by the end of the year. But again, last year we had 6. And going back to the performance of the market, I've tried this trade with trying to play some of the smaller caps and fading some of the large caps, and that gap has just widened. I'm looking at it now. Year to date, we had S&P up 18.5%. Russell's at 1.5%. So that gap has just continued to widen out. The haves are continuing to have more, have-nots not as much. So again, I think the Fed sitting where they're sitting, a lot of different variables they're worried about. Again, is it going to be because of economic data? Is it the election? How are they going to be viewed? But again, you don't want to get caught behind the 8 ball again, where data turns really negative, and that's where we're starting to cut and say, okay, we're late, market's starting to turn. And then what do you do when things are starting to cut? You're like, oh, wait a second, we were late again.
That's what I want to jump on. I hate to be a Fed basher, but I think that when you look back in history and they talk about policy mistakes, I think the real policy mistake was rates too low for too long. We deal with a lot of fixed income managers, and they were screaming, why are we at 0%, 50 bips on the 10-year Treasury? You should have been at 2%, 2.5%, 3%, et cetera. Now I think they're going to do the flip side of the policy mistake.
So is patience a virtue now?
Yeah,
or?
yeah, and now you're too high. I mean, the higher for longer camp is beginning to look a little embarrassed right now, because if we get, and I'm glad you brought up the same rule, because I thought I was the only one that had learned that esoteric rule from Claudia, a Fed economist, that came and said the rate of change of unemployment is beginning to accelerate. So, we're in this kind of no man's land where if the Fed starts cutting rates, is this the ultimate in the equity markets? Buy the rumor, sell the news, because again, if the economy is starting to glide down, I think you could end up hitting some kind of air pocket in the financial markets. I'm not calling for in October of '87, but if you've noticed the market the last couple of days, it continues to rally on less and less volume, which is never a good sign.
Well, you also have a VIX at 12.5, which
Correct.
always makes me nervous too. But Phil, I think that's it was confusing for me in December when the market was moving on the fact we could get 6 to 7 rate cuts, and we actually have hit new highs without any rate cuts, which suggests to me that it's more on fundamentals than just betting that we'll get rate cuts. If we were to get 6 to 7, that made me nervous, because that suggests there's a big issue if you get that many in 1 year.
For sure, and if something broke. But I think our question is about, all right, will the market sell off? So then the question is, will the Mag 7, specifically the Mag 2, maybe Mag 3, will they be hurt in an interest rate cutting environment? Traditionally, no. Microsoft will lose about $1 billion based on the cash they make. They have $140 billion in cash. They make $4 billion a year. Maybe they make $3 billion. Okay. But will the Mag 7 be hurt? I would argue probably not so much. To your point, if the economy is cracking and breaking and we're having to cut quickly, that's a different narrative. And I think we got to not forget we have a lot of seasonality in front of us. Let's not forget August and September, the worst months of the year. So seeing a sell-off of 10% because you have, call it 16.5, 17 times on the S&P X Mag 7, and with Mag 7 22, it's not cheap. And unless we get a phenomenal third quarter earnings season, or even more so, just this one we're in right now, coming in at 8 to 9%, it's going to be really hard to hold up here at a time when we don't. So I would say to your viewers who are listening to this thing, be smart about this. Where can I get my best value? If I own NVIDIA and I've made, I can name my life, CrowdStrike, I'll pivot completely. I bet a lot of your viewers have it. It's a great NASDAQ name. You're up 110% depending on when you bought it. We recommended it over a while ago. Take 50, 75% of that and pivot to some of the things you hit on. Because why? Because I'm not going to get hurt as much in value in stocks that have fair valuation.
Right, we have to be somewhere, right? You're not getting paid to manage money to not put your money somewhere.
Well, I'll go one provocative thing that I can't help myself. I still think people do not see this tremendous, and I put bells and whistles around it, the bond trade. If you really want to be aggressive in equities, go buy the 20-year TLT. Why? Because I'm going to get equity-like returns with a fixed income U.S. Treasury-based investment. Why? Just look at November, December of last year. We sold off 1% on the 10-year. We made 18% in that position.
Well, I'll jump on that trade too, because I like what they call the bullet trade, where everybody's crowded on the short end of the scale. I like EDV better than TLT, but it's the same thing. It's a bullet trade, and if you put 5 or 10% of your bond portfolio in that, and again, the rate cuts start coming, you're going to get that double-digit rate of return.
Why fight the Fed? Eventually they're going to get what they want, right? You're right.
So we've been saying it for 15 years. I mean, why would now be any different?
Right. Exactly right. So I don't understand why anyone's trying to fight it. Okay, I'll take what the Fed's going to give me, even if it's the hint of a rate cut. We're going to see the 10-year fall below 4. Maybe one cut gets you to 3.95. I think the natural rate's 3.50, 3.35, somewhere in there. I'd love your opinion, Phil, where the natural rate is.
That's 2 whole % less than we are now, so that's 8 cuts. Like, that's where the math of what you just said, it sounds scary until you realize they're quarter-point cuts.
Exactly.
I mean, I worry that we're going to get to the end of this year and have half-point cuts because things are slowing down, but you could easily get down to 4%, 3.75, and it's not that low an interest rate, not compared to what we have had recently.
Exactly. So imagine what the bond market's going to do?
Right.
We're going to kill it. So I can wait. I can get a safe investment and get double-digit returns. To me, take some profits from those gigantic equity positions, either rotate to mid and small, which we're just not fully there yet. We're nibbling at it because it's just been painful. I mean, small caps were down for the second quarter. Small cap value is down for the second quarter. That's painful. So you got to be real careful about being too convinced that you're right. But at the same token, if I can buy a fixed income investment based on the U.S. Treasury, the best bond market in the world, and get double-digit returns, and not fight the Fed, well, that's an easy trade.
So then, Phil, you're saying basically the perception is, if you going to look at financial media headlines, if we were to get 50 basis point cut, right, whether it's in November, whether it's in December, it's going to be more like, oh, we got 2 in one rate cut cycle. What does that suggest about the economy? But the math might be a little bit different than what the headlines might be saying.
I think that's why I guess I'd prefer to see more cuts early, because more little cuts is not going to send a signal.
What is it, like
panic.
paper cuts, like,
Not
dying
death
paper
cuts.
Yeah.
You'd rather that, though, wouldn't you? It's like, I mean, we know it has a lagged effect, 12, 24 months. I would say in this cycle, the problem is it's having no effect because everybody with their home loans and their mortgages just can't move house, but they're not paying extra interest because they're in a 30-year mortgage fixed. We've seen that from the interest expense. The mortgage interest hasn't really gone up because everyone's just stuck in their house. But we've also seen it in the housing side because there's not enough supply. And so prices have stayed high. I mean, that's one of the distortions. You talk about lower for longer created a whole lot of distortions. This is creating distortions too right now, but in some really weird areas where house prices are actually high because interest rates are so high that no one can move.
Do you think that sets up for some sort of crash in real estate?
No, I just think it's creating some weird bubbles in the way that people are spending and the way that people are able to move jobs, and it slows the economy down a little bit because the mobility factor's not there. People can't downsize as easily because they just don't want to leave the house and the mortgage they've got. And that's just not letting the economy kind of get moving the way it should.
Yeah. But talk about that bifurcated market. So we now have wealthy investors who were getting 0 on their safe money, and now you're getting 5% on $1 million is $50,000 a year. So they're still out there spending. And I've said this the last 6 to 9 months, everybody's worried about high mortgage rates and what it's going to do. And I'm like, well, whoever's not worried about high mortgage rates are investors. A 7% mortgage for an investor is really good. And guess what? Rates go down 100 basis points. You're right, a double-digit rate of return off of a mortgage product. We haven't seen that in about 7 years. So,
yeah, I mean, it's crazy to get a mortgage rate that's actually almost double less than what a savings rate could be.
Right.
So is this idiosyncratic to what's happening right now, or are there other points in history where we saw some of these types of distortions?
Well, this is one of the biggest arbitrages I've seen. Where people are sitting there and going, okay, what can I get on my safe money versus going out there and, some of the market pundits have come out and said, well, if you're in a 5% money market fund, look at what the S&P is up so far this year, and you're going to be leaving a lot of money on the table. These older baby boom investors don't care about leaving that money on the table because their house is paid off, they're financially in good shape, et cetera, where we're getting the sandwich generation, those people putting kids through college, trying to upgrade their home, et cetera. Those are the ones that are really getting squeezed, and so they don't have the ability to arbitrage like a wealthy investor can arbitrage right now, and I think that's another problem that we're seeing this,
the classic arbitrage is you're paying 4% on your mortgage and you're starting to deposit for 5.5. I mean, why would you pay your mortgage down?
Exactly.
Yeah.
We have $5 trillion in M2 right now for that reason alone. Just sitting there, earning its income. So they're smart enough to move to a money market. But that money's never, the Fed's trying to pull it out of the system to slow the system down. why inflation's been so stubborn. There's plenty of cash around. Back to my point earlier. Most folks got a job if they want it. Participation rate between 25 and 54 is 84, nearly 84%. That's the best in a lifetime. People got a job, they're making money, they can survive this.
Yeah, but Max, it's interesting. I guess you and I are part of that sandwich generation. Well, me more putting kids through school versus you, but anecdotally, I feel like you and I are hearing different stories in terms of how people are perceiving the economy and how it's, the dollar isn't stretching day to day.
For sure, because they're in that, call it upper middle class that are in jobs, they've been paid well, but not exorbitant amounts. Cost of everything has gone up. I know personally, and I have 2 kids, a 3-year-old and a 3-month-old, what childcare costs, how much that goes. I go to the food store yesterday or 2 days ago just to get a few small pieces. It's $70. Now again, it's not a huge thing, but the way you're interpreting it is, wait a second, my wage increases haven't kept up. Costs are going up. The cost of a house, again, because that my family is growing, and my people our age, that our families are growing. So you need to upsize. The cost of that is real, right? Now, again, previously, it was 3%. I had a sub 3% mortgage. I had to move, and it basically doubled. And more people are feeling that when, again, you don't have the house paid off, that extra income is going to those kind of newer expenses, new childcare, school expenses, bigger house. So those are kind of catch up, and that's the sentiment is. Everybody hears on TV now, inflation's coming down. It's at 2.5%.
Data
3%.
doesn't matter as much the way we look at it.
Correct, because it's how much money's coming in my pocket, how much is going out on my day-to-day, everyday life expenses.
Why do you think everyone wanted to go hybrid? The cost of childcare. You have to work a full-time job, a decent job like we have, just to afford, a nanny or childcare.
Well, Jill, that comes back to one of my basic theses is that as many people believe, wrongly so, that inflation goes up in a straight line. It doesn't.
Right.
We've had a period of literally 10 to 15 years of low, almost non-existent inflation. And I keep going back to the 1980s. In the 1980s, you had high energy prices, high interest rates, and high inflation. Well, then in the 2000s, you've had low energy prices, low inflation, low interest rates. Well, now, again, we're going back to the 80s, where we are now in this environment with high energy prices, high interest rates, and high inflation. And there's a whole new generation that's got to deal with literally what people in the 80s have to deal with. Now, one of the things that happened in the 1980s, it was one of the best decades for stocks. And what I can't believe is not happening at a faster pace is that in the 1980s, you had a ton of mergers. Because if you're a major company, rather than build some other facility, it's cheaper to buy some another company. We're seeing that like in the pharma industry, but I am surprised we haven't seen more big name mergers of companies just to take advantage of literally even more economies.
You're looking on the wrong side of the dial. The public sector, there's only 4,000 stocks traded left.
Yeah.
And then you go to private sector, 90% of the country is employed privately now.
Right.
Plenty of mergers there, just that the average investor on the show or watching the show can't do it.
But think about it this way too, if you have private equity that has swept up some of those smaller cap names as an example, they're going to go for the best. They're going to be discerning about it, right?
Yep.
So perhaps that has been picked through. Companies are staying private for longer, whether they're looking at alternative forms of raising capital, particularly in an environment that we just came out of.
BDC.
Right? So, I mean, look at the growth in alternative investments for that reason, particularly in the private credit space. The composure of the market is different this time. I know everyone hates that phrase, but
the IPO market has picked up. Like
it has
first
picked
half,
up.
we've seen almost 100 IPOs. A bunch of them have been unicorns.
Right.
And I think people aren't talking about that, but there's starting to be a recovery in the IPO side of the market. And some of them are bigger cap companies.
And understood
profitable.
100%, but we can't ignore the fact that companies are looking at alternative forms of raising
It's
capital as well. I mean,
competitive,
again,
that's for
coming
sure.
out of the pandemic and how things were more restrictive, you're going to think of alternative forms.
Let me add to Max's point. The Journal, to its credit, did a great piece on what a basket of groceries would cost pre-pandemic versus post. It was $100 before, now it's 140 post. So it's a 35 to 40% increase in cost. You're spot on right. I guess my argument is the reason why I like other things in the stock market to tie in where we began this thing is the only reason that's working is 7 stocks, arguably 2 or 3. If you get a rate cut where the pressure comes off the consumer in their credit card or their living expenses and inflation goes back to the delta, the annual increase is relatively flat or normal at 2.5%, then I think you get a better consumer. Then the market broadens out. That's kind of my thesis of this. I completely agree with you. Consumers living below $100,000 in salary, paycheck to paycheck, because of that increase.
Yep.
They're not defaulting yet, but and we won't see that pressure come off until rates go
Yeah,
up.
it's just that kind of excess savings that you could invest. You kind of have to be a bit safer with it. and put it into bonds or into a money market fund or some treasuries. You're collecting a few percentage points on it. So you have to give up some of the the potential upside of the market because you can't really put that money at risk because again that's either your down payment or it's funds that you're using on kind of what you didn't used to use as a day-to-day cost as your bank account for your day-to-day stuff, for your mortgage, for the child care. You're starting to dip into that more. So again, it's still there. It's just where you can allocate those funds and kind of how you choose to spend it versus what used to be a lot more of discretionary.
Well, what I hope doesn't happen to
30 seconds.
your generation is that everybody's really flowing into the index funds, which are being driven, by the large cap stocks. And I hope we don't lose a younger generation of investors that just say, hey, put it in index funds and call it a day. Because again, because of CapEx spending, you could see those large companies not do as well in the next couple of years.
All right, we've got to wrap it up there. Thanks so much for everyone's insight, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.